Alright guys, warm welcome to another week video. This week's video will cover the trading week running from Monday the 16th to Friday the 20th of August 2021. And even though it will be a busy week ahead, our main focus will be on the Kiwi dollar as well as that upcoming RBNZ meeting that we've got scheduled on the 18th. Now, from a fundamental point of view, the outlook for both the Kiwi dollar as well as the New Zealand economy looks solid. Apart from New Zealand's obvious success in keeping the virus under control, the recent economic data has been much better than both the markets as well as the RBNZ expected, and it has sparked expectations of much tighter monetary policy from the RBNZ in the months ahead. If we take a look on screen, the Q2 jobs print absolutely blew expectations out of the water, with the unemployment rate dropping back down to pre-COVID levels at 4%. As well as the job growth that accelerated much more than anticipated by the forecast. Now, with the tightness of the labor market, we also saw private sector ordinary wages shooting up to the most in 13 years. And the data suggested to some that the economy right now is performing a little bit faster than its capacity could allow, and suggests that the RBNZ is already behind the curve in terms of monetary policy. And as a result of that solid Q2 jobs print, we saw participants like ANZ, Bank of New Zealand, JP Morgan, Westpac, TD Securities, just to name a few, all expecting the RBNZ to raise rates at least 3 times before the end of the year. We also had the most recent inflation data. It's been equally hot with that Q2 CPI print coming in at 3.3%, which is the first print above the RBNZ's 1 to 3% target band in 10 years. So pretty significant jump there. Furthermore, this week's inflation expectations that we had showed the 1 year coming in at 3% and the 2-year inflation expectations coming in at 2.27%, also putting in equally impressive jolts higher. Now, it's important to remember that the RBNZ doesn't have a flexible approach to inflation like the Federal Reserve. They obviously have the average inflation targeting. The RBNZ doesn't have something like that, which means that the current overshoot will no doubt be a very big concern for the bank to deal with. We also have housing prices. That's another key factor because housing, if you guys recall, was made part of the RBNZ's remit in February this year, alongside, of course, the New Zealand government's push and promotion towards more affordable housing. So with house prices still roughly between 20 and 30% higher than just a year ago, that will be front of mind, no doubt, for the RBNZ as well. Now, apart from jobs data, apart from inflation data, apart from house prices, we also have the growth picture, which is also solid right now, with Q2 growth coming in at 2.4%, well above the Q4 2019 growth number of just 1.9%. So with all of this in mind, a hike for this upcoming week's meeting is all but priced in right now. We've got OIS markets implying about 100 basis points of tightening between now and the second quarter of 2020, with a hike fully priced in for this week, 1 more hike implied for November this year, and then 2 more hikes implied for the first half of next year. Now, despite all of that aggressive pricing for interest rate hikes, the Kiwi dollar hasn't really reflected that fundamental reality over the last couple of weeks, remaining very close to flat. If we take a look at that purple line, which is the Kiwi dollar, very close to flat from the start of the year against a basket of the other major currencies. Now, with a hike fully priced in for this week, the likely reaction from the hike itself might be more muted, as the majority of markets' focus will arguably be set on what the RBNZ's updated monetary policy statement will have to say about the projections for future potential hikes. So remember, a hike for this week fully priced in. If that happens, it should be more muted. What the market wants to know is that, okay, after this hike, will we see the 3 total that some banks have been pricing in and a potential one coming in the first quarter of next year, or will we see the markets being disappointed? So if the RBNZ confirms that more aggressive forecast of 3 hikes before the end of the year and a possible 4th one in the first quarter of 2022, that could be just what the Kiwi dollar has needed over the last couple of weeks to push it higher in line with that fundamental reality. However, recall that the RBNZ, with their previous meeting, they called their decision to stop their LSEP program a least regrets policy decision, and they also stated that some monetary policy stimulus is still necessary. So the risk right now is that they don't confirm the more aggressive bets and only potentially project 1 more hike after August, as is the expectations right now for ING Investment Bank. Now, ING has acknowledged that the Kiwi dollar hasn't really been performing as well as one would have expected it to, and they suggest that the Kiwi dollar should still benefit in the medium term from upside, not only due to the obvious monetary policy divergence, but also from its carry attractiveness that will start to improve once rates start moving higher in New Zealand. But, ING is wary right now of the markets being potentially disappointed at this week's meeting, which could obviously weigh on the Kiwi dollar in the short term. Right, so in terms of a trade plan then, it's going to be very, very simple. Looking for an either hawkish tilt or a dovish tilt by the bank. From a hawkish point of view, remember that right now, the expectations of a 25 basis point rate hike is pretty much priced in by the market. So the only way that the market is going to be surprised at this week's meeting is if the bank, the RBNZ, doesn't come out with a 25 basis point hike, but actually comes in with a 50 basis point rate hike. So that'll be a very hawkish tilt from the bank. Furthermore, if their projections in their monetary policy report, if it confirms 3 hikes total for this year and 1 more for Q1 2022, that'll confirm the more aggressive bets in the markets right now. That is also expected to see upside for the Kiwi dollar. Furthermore, if the bank explains that the current price pressures we've seen, if it is a real big concern for them, alongside, of course, house prices, that'll mean that the current levels of inflation means that the bank is seeing that as a reason for tighter monetary policy. That'll also be expected as more as a hawkish tilt, as long, of course, as inflation data remains high. And furthermore, if they state that the economic data and house prices shows that the economy is running the risk of running a little bit too hot, implying that they are behind the curve, that'll also imply a bank that is ready to act more aggressively in terms of tighter policy. So that should all be more on your hawkish side of things. In terms of dovish expectations, remember that right now, again, expectations are for a 25 basis point hike. So the biggest dovish surprise this week will be the bank coming out with no hikes. And that'll be, a lot of repricing that's required. You'll see the Kiwi dollar and Kiwi 10-year yields tanking on the back of that. So that'll be a first reaction that we'll expect. Further dovish signals to watch out for is just the exact opposite from above. If we see them projecting only 1 hike after the August hike and 1 more in 2022, that'll obviously go against those more aggressive expectations right now. That is expected to see more downside for the Kiwi dollar. If they explain that the current price pressures we're seeing isn't really a point of concern for them right now and no reason for tighter policy, that'll also be more negative, because if a 3.3% inflation doesn't scare them, what type of inflation numbers will? So that should be seen as more as a dovish tilt as well. And if they come out saying that the current economic data we've had and house prices is no point of concern right now for the RBNZ, obviously that is also expected to see more of a downside move in the Kiwi dollar. Now, if we do see a hawkish tilt, we would obviously expect to see Kiwi 10-year yields and the Kiwi dollar up, because we do like the Japanese yen, the Aussie, and the euro to the downside right now. We're expecting to see upside in Kiwi yen, downside in Aussie Kiwi, downside in euro Kiwi, and in terms of the dovish expectations, just the exact opposite. Now, the one thing that we just do need to keep in mind for all 3 of these pairs, meaning the Kiwi yen, the Aussie Kiwi, as well as the euro Kiwi, is that all 3 of these currencies, the Japanese yen, the Aussie, as well as the euro, all 3 of them are showing some very important reasons for a little bit of caution right now based on the most recent CFTC data positioning. So do make sure to catch our updated fundamental drivers report in the terminal for more information on that. Right, guys, so that's everything from our side. Hope you guys will have a fantastic week ahead. Good luck with trading the RBNZ decision. And as always, if there's any questions, please don't hesitate to let us know.